Okay, let's dive in. We've got some really interesting source material here on the mortgage market. And that's a topic that, well, it affects almost everyone, right? Buying, selling, just watching your finances.
Absolutely. And what's really intriguing, I think, is how these sources give us such a detailed picture. It's kind of like pulling back the curtain on what's really shaping real estate today, the hidden stuff.
Exactly. So our mission here in this deep dive is basically to pull out the key nuggets for you, help you cut through the noise, understand the current trends, what's actually driving them, and importantly, what it all means for your financial future.
Mhm.
Think of it as your shortcut to getting informed about the housing market's twists and turns. We'll hit current rates, look at longer-term trends, even how government actions play a role.
Sounds good. Lots to cover.
Definitely.
Yeah.
So let's kick things off with the numbers everyone's focused on right now. Our sources are saying as of July 18th, 2025, the average 30-year fixed-rate mortgage, the FRM, it's edged up to 6.75%. But here's where it gets really interesting. The 15-year FRM, that's sitting at 5.92%.
Wow. Yeah.
That's almost a full percentage point difference. What does that gap really mean for someone trying to decide?
Well, it's a huge difference, not just a number on a page. That gap, about 0.83%, it translates into pretty substantial savings over the whole life of the loan if you go for the shorter term.
Right, less interest paid overall.
Exactly. So for you, the listener, it really boils down to a critical trade-off.
Hmm.
Are you prioritizing keeping that monthly payment lower right now? Or are you aiming for, significant long-term savings and building equity faster?
Mm-hmm.
Because that 15-year option, while it saves money eventually, it does mean you need a higher income generally.
Mm-hmm.
Or you've got to be willing to put a bigger chunk of your budget towards the house payment each month.
Makes sense. Okay, and what about adjustable rate mortgages? ARM's sources put those at 6.04% currently, July 18th. That's after they spiked up last December briefly.
Yeah, remember that spike?
So right now they're, about 0.71% lower than the 30-year fixed, but they come with a different kind of calculation, don't they? A different risk.
Precisely. Yeah, AIMs can sometimes give you a little bump in how much you can borrow up front, which is tempting.
Yeah.
But that inherent volatility, it creates significant risks down the road. We saw that with the December spike you mentioned.
Right.
The biggest worry is, well, foreclosure. If interest rates shoot up and suddenly those payments become unaffordable.
Yeah.
Historically, ARMs were often more common for like high-value homes or commercial properties, places where the borrowers were maybe a bit more sophisticated in managing that kind of interest rate risk. It's definitely a calculated gamble.
Okay, so looking ahead just a bit, near term, where are rates headed? The sources seem to suggest there's this prevailing expectation, generally, that fixed rates might trend downwards through 2025.
Hmm.
Sounds good, but the reports also say it's not quite that simple.
That's right. It's not a straight line down. That anticipated dip, it really hinges quite heavily on the Federal Reserve, on their ongoing efforts to, get consumer inflation fully stabilized and encourage sustainable job growth.
But the Fed's job is tricky here.
Incredibly tricky. They're juggling all these residual disruptions from the pandemic. Supply chains are still messy in places, labor markets too. Plus, you've got government trade policies in the mix, changes in migratory labor. These things create distortions.
Right, it's not just one thing.
No, and these aren't just abstract issues. They show up at the wholesale level, economically speaking, and then they trickle right down to you, the consumer. We're actually seeing evidence of that already. Personal savings are up, discretionary spending is noticeably down. It signals a very cautious consumer base out there.
That makes perfect sense. But it's not just the Fed's actions, is it? Our sources also talk about how current governmental interference in the broader economy is having this discernible spillover effect, specifically on real estate.
Yeah, that's a key point.
What does that actually mean for mortgage rates, construction costs, turnover?
It means all these conditions together are contributing to an industry-wide slowdown. Fewer fee-related transactions happening throughout 2025.
So hitting agents, lenders.
Exactly. Real estate agents, lenders, appraisers, other service providers, they're feeling it. And this overall uncertainty, it also spooks bond investors. That leads to these volatile swings in the 10-year Treasury notes we've seen recently.
And those treasuries are key for mortgage rates.
Directly linked. So all this slows down property sales, leasing activity too. Buyers and sellers just sort of wait and see.
A holding pattern.
Pretty much. And the sources suggest that to offset the government's own demand for cash and stop long-term rates from rising across the board, we might need to see either higher income tax revenues coming in or maybe the Fed stepping back in with more bond buying programs. It's all interconnected.
Okay, so despite that sort of murky short-term forecast, maybe some downward drift through 2025, 2026, these sources reveal something bigger, a significant long-term upward trend in mortgage rates that's expected to pick back up after that.
Hmm.
And what really jumped out at me is that this trend apparently started way back around 2013.
Yes, that's a critical piece of context. It didn't just start now. Analysts in the material describe this as the start of a half cycle of rising rates.
A half cycle.
Yeah, basically a long-term phase, maybe spanning like 3 decades.
Yeah.
Where rates across all kinds of borrowing gradually climb.
Wow, 3 decades.
It suggests a really fundamental shift away from that super low-rate environment we got used to in the early 2000s.
So what does that mean for people listening, for future buyers?
Well, it implies that for you thinking long-term, future generations of homebuyers, investors, they're likely facing a consistently higher cost to borrow money. And that necessitates real adjustments in how we value property, what we consider affordable. It changes the whole equation.
Okay, let's dig a bit deeper into why rates are where they are right now. The sources point to something specific. This ongoing debate around privatizing the quasi-government mortgage agencies, Fannie Mae, Freddie Mac.
Right, the GSEs.
Currently, they absorb a lot of the lender's risk, right? Through government guarantees.
They do. They effectively socialize a big chunk of the lender's potential loss if a borrower defaults.
So what happens if they're privatized?
Well, the sources say privatization would shift that risk squarely back onto the lenders themselves. But it would also enhance their potential for profit sharing.
Ah, okay.
But this dynamic, even though it might look good for the private lenders on paper, it collectively helps keep mortgage rates elevated for borrowers. It adds a layer.
Interesting.
And it serves as, a stark reminder. One source bluntly put it, all financial deregulation goes up in flames.
Oof. Yeah, thinking back to 2008.
Exactly. The crash back then, starting around 2005 really, was a direct result of lax lending and deregulation. History has lessons there.
And tied into lender risk, the sources also highlight that fundamental link between fixed-rate mortgages and the 10-year Treasury note. We touched on this.
Yes, intrinsically linked.
Yeah.
The 30-year fixed rate usually moves pretty much in lockstep with the 10-year Treasury yield, but with an added bit on top, the lender's risk premium.
Okay, explain that premium.
Think of it as the lender's cushion. It's the extra percentage they charge to cover their perceived risk that you, the borrower, might default.
And what's normal for that?
Historically, it's usually been somewhere between 1.5% and maybe 3.0%, with a normal spread considered around 1.5 percentage points above the 10-year Treasury.
Okay, so where are we now? July 18th, 2025.
Right now, the 10-year T-note is hovering around 4.42%. The sources suggest this reflects a kind of decline in really good, rational investment options elsewhere.
Okay.
So consequently, the current spread between that 4.42% Treasury and the 6.75% 30-year fixed mortgage, it's widened out to 2.33%.
Whoa, that's way above the normal 1.5%.
Significantly above. And what that signals, according to the analysis, is that mortgage lenders right now are just in no rush to lower that perceived risk premium, even if it means they write fewer mortgages. They're prioritizing keeping their operations profitable in what they see as a very uncertain market.
Wow, okay. So with all these forces swirling around, cautious lenders, higher premiums, economic uncertainty, what does this mean for you, the potential buyer or seller out there? The sources show buyers are increasingly, retreating, pulling back to the sidelines. Why?
It's a key question the sources tackle. Why the hesitation? It boils down to affordability and pricing. Higher rates, both fixed and adjustable, are having a significant impact on property prices, especially since 2013, actually, when the sources say income property values started to decline as capitalization rates went up.
Explain capitalization rates quickly.
Sure. Cap rates basically measure the expected rate of return on a real estate investment property. Higher cap rates generally mean investors demand higher returns relative to the income, pushing prices down.
Got it. So higher rates hit prices.
Right. Because ultimately, property pricing is supported by how much a buyer can actually borrow.
Makes sense.
And that borrowing capacity is then tempered by how much rent the property could potentially generate, because that rent needs to cover the higher mortgage payments.
It's a balancing act.
It is. So these annual increases in fixed mortgage rates we've seen since 2013, they force sellers to make a choice, eventually cut their asking price or just pull the property off the market as inventory piles up.
And we're seeing inventory rise.
The sources suggest inventories are accumulating, and that usual annual spring bounce in sales, it's been notably weaker since mid-2022. Plus, specific factors like the sources mentioning continued job declines in California without offsetting immigration that's expected to put even more downward pressure on prices there.
So, safe to say the FOMO, the fear of missing out from like 2021, that's long gone.
Oh, absolutely dissipated, replaced by deep caution.
So, for prospective homebuyers listening, what strategies should they even be considering right now? It sounds tough.
It is tough. For anyone relying on getting a mortgage to buy, the sources basically lay out a difficult choice. Either you adjust your lifestyle expectations, maybe your investment goals, perhaps look at property in a lower price tier,
Right.
or you practice patience and wait for a more significant drop in property prices. What the analysis really highlights is that the general public, consumers, they've become much more cautious.
Hmm.
People seem acutely aware that today's conditions create this kind of double whammy.
Double whammy.
Yeah, the risk of buying an overpriced property while also locking in mortgage funding at these high fixed rates.
That's a tough pill to swallow.
It is. And that realization has led to this growing number of potential buyers just heading for the sidelines. It's not that they can't buy. Many are financially ready and able. They're just unwilling to commit or borrow on what feel like unfavorable terms.
Okay, but despite all this current buyer reluctance, this caution, there seems to be maybe a silver lining, particularly for patient, persistent buyers, maybe those with lower down payments, and their agents. Sources point to conditions for buying actually improving significantly, but maybe not until around 2028.
That's the projection, yes. If you step back and look at the cycle, the market seems to be entering what the sources call a recession window period.
A recession window period, what does that look like?
It's basically a phase, often following economic stress, where things temporarily shift a bit more in the buyer's favor due to market adjustments.
Hmm.
It'll likely be marked by noticeable growth in the number of homes for sale, more inventory,
Yeah.
an increase in price cuts from sellers who feel compelled to sell, and probably a slight reduction in mortgage rates, just enough to help facilitate some deals.
But buyers might still be hesitant.
Exactly. The sources anticipate continued buyer reluctance during this window, until there's a sense that property pricing has truly hit a clear bottom level.
Finding the floor.
Finding the floor. And this whole process, this adjustment, it's expected to be slow, unfolding gradually over maybe 30 months or so. So it demands strategic patience from everyone involved, buyers, sellers, agents.
Wow. Okay. So let's try to wrap this up. Bringing it all together, what does this mean for you, the listener, trying to navigate this market?
We've definitely seen the landscape as complex. Elevated rates, very cautious buyers, big economic forces, government actions.
Yeah, and what the analysis really brings home, I think, is that interplay between potential short-term dips in rates versus that longer-term upward trend we discussed.
Right, the half cycle.
Understanding the Fed's really delicate balancing act, the ripple effects of government policies, those lender risk premiums, it's all crucial context. Which leads to the big question for you. How will these insights actually shape your long-term financial planning, your investment strategy in real estate? Especially given this fundamental shift towards, likely, a consistently higher cost of financing than we've been used to. It really reframes things. And maybe here's a final thought for you to mull over. As the market slowly works its way through this recession window over the next few years, consider not just when the right time to buy might be, but also how this fundamental shift in the cost of money, moving away from those historically almost artificially low rates, how that might force a complete reevaluation of what even constitutes a good deal or an affordable property in the decades ahead. Something to think about.